Have you ever gone to buy an investment, seen ETFs and mutual funds side by side, and thought, which one do I choose? What's the real difference? Both can grow your money, but the way they work is completely different. Here's how. Welcome back to Smart Money MVP, where we break down money stuff in a way that actually makes sense. If you're new here, hit that subscribe button so you don't miss future videos to help you take control of your finances, one smart move at a time. ETFs can be bought and sold at any point during market hours, with their value shifting throughout the day. Their prices change in real time as the market moves. Mutual funds, on the other hand, are only priced once a day after the market closes. You can't buy or sell shares during the trading day, and all transactions are based on the fund's end-of-day net asset value. Think of an ETF like buying a basket of investments right off the shelf. You can see exactly what's inside and grab it instantly at the current price. Now, picture a mutual fund as a chef's special. You place your order, but you don't know the exact ingredients until the kitchen sends it out later that day. When it comes to management, ETFs are usually on autopilot, designed to follow an index like the S&P 500, almost like setting your GPS and letting it drive. Mutual funds, on the other hand, often have a human at the wheel, a fund manager making active decisions, aiming to beat the market. ETFs are usually passively managed, meaning they aim to mirror the performance of a market index, such as the S&P 500. Some ETFs are actively managed, but that's less common. Mutual funds are more often actively managed. A fund manager, or sometimes an entire team, actively selects investments to buy and sell with the goal of beating market returns. Transparency is another key difference. ETFs typically report their full list of holdings every day, which allows investors to see exactly what they're invested in. Mutual funds usually disclose their holdings only once a quarter, and often with a 30-day delay. This means less visibility for investors in real time. And here's where taxes come in. ETFs are generally more tax efficient due to their unique structure, which helps reduce the capital gains taxes investors may owe when they sell shares. Mutual funds can trigger capital gains taxes even if you don't sell your shares, especially in actively managed funds where frequent trading occurs. Let's talk costs. ETFs often come with lower expense ratios, especially those that track an index. However, you might pay a trading fee when you buy or sell them, though many platforms now offer commission-free ETF trades. Mutual funds may charge higher management fees. Some also include sales charges called loads, which are additional fees for buying or selling shares. ETFs are flexible when it comes to starting out. You can usually buy as little as one share with no minimum investment. Mutual funds often require a minimum initial investment, which can range from a few hundred to several $1,000s depending on the fund. So, which one's right for you? Go with ETFs if you want more control over your trades, prefer lower fees, want real-time pricing, or value greater transparency and tax efficiency. Choose mutual funds if you'd rather take a more hands-off approach, let professionals manage the details, and don't mind higher fees or less frequent updates. In the end, it's not always about picking one over the other. Many investors use a mix of both: ETFs for low cost, transparent exposure, and mutual funds for professional oversight in certain areas of their portfolio. It's about matching the tool to your investing style and goals. If you found this helpful, hit the like button. Subscribe for more simple, smart money tips.